Joseph Rizzello, Chairman and CEO of NewSquare Capital, and Ryan Kirk, President and Head of Portfolio Management at NewSquare Capital. Your firm has the view that defensive strategies are sometimes underappreciated. So, what types of defensive strategies does NewSquare Capital look at?
Right, you want
Yeah,
to get
Joseph.
yeah,
Yeah,
you
Joseph. I guess I could jump in for a second. I think when we talk, Chris, about the defensive strategies, and you mentioned the underappreciated nature of them, I think that maybe because markets go up the majority of the time. So anytime if you're in a strategy that's maybe always defensive or hedged, it's going to tend to show some underperformance. And when that happens, there's a lack of love for a strategy like that. So as we know, bear markets only come around so often. Although the last few years, we've seen a number of bear markets in a number of calendar years. So for the defensive strategies, we kind of view it as the insurance side of things. It's like flood insurance before a storm or home insurance before a disaster. If you don't have it when the storm hits, it's too late, and you can't get it when you need it. So I think it's something that needs to be prepared for, and that's the same with defensive strategies. These things always need to be sort of looked at if it makes sense for the right investor. And I just think for a lot of those reasons, these are the types of things that they're underappreciated until they're really needed during those disaster type times.
And how does emotional control factor in to portfolio management and working with clients?
it's emotional control is critical at all times when you're an investor because markets are ultimately reflections of human behavior. Even the most sophisticated strategy analysis can be undone by emotional reactions. And, uh, you know, fear of drawdowns. Ryan just talked about the importance of defensive strategies. It's interesting. You can have an extremely aggressive investor in the up where the markets are trending up, and then all of a sudden you get this drawdown or volatility comes into the market, like we saw in early April, and they become the most conservative investors. So emotional control enables investors to stick to their strategy, adhering to the predefined investment principles, whatever the disposition of that strategy might be. And all of that should be talked about right up front, risk profile, what your expectations are, so that you can find the right uh, strategy for the temperament of the investor. So emotions is markets are driven by emotions. And you want to be able to calm your emotions, particularly in the most challenging times.
So, given both of those things, the benefits of defensive strategies and the need for emotional control, what does success look like in today's markets?
Success looks different for each investor, but I think when it comes to the emotional side of it, and you just mentioned that sort of technical knowledge, um, if you're in charge of your emotions, as Joseph was just alluding to, that's never going to fail you. The technical piece of your portfolio, at times that's going to fail you. It's just in any strategy, it's going to go through these periods of underperformance. But if you're in charge of your emotions, that piece of it's never going to fail you. So I think from a broader point of view, we would think that is success. If you have a strategy that aligns with your line of thinking and you can carry it through all the way to sort of the end of your investing time horizon, wherever that is, we would argue that that's successful investing for the individual investor.
Yeah, just to add to that, Chris, in my long career, the stock market rewards discipline, not impulsiveness. I mean, the data is clear on that. Daily market headlines, they can tempt the investor to do something that they shouldn't be doing. The reality is that wealth is built by maintaining a consistent process-driven approach. That's what we do at NewSquare. The other thing is you may get questions if you're an advisor. We're, here at NewSquare, we're asset managers, and the best advisors, I think, they'll hear the question from the client, when is the best time to enter the market? I think The better way is not whether this is the best time, but what is the best way to invest? What are the principles behind what makes it a good investment decision?
And I guess we should also talk about how to address FOMO, the fear of missing out, especially when we're at a time when the stock market is high and there's seems to be a strong appetite for risk, but at the same time, everything we just discussed, fundamentals and defensive strategies and emotional control. So how do you guys deal with FOMO, either from dealing with other advisors or clients?
Yeah, I mean, again, I always look at it from the opposite way, but investors repeatedly abandoning sensible strategies at precisely the wrong time, right? Chasing performance, that's fear of missing out. They look at something beside what they own and they decide to chase it, and that typically is right at the wrong time. Again, it's managing their emotions, but really, um, hearkening back to the initial discussion with an investor, what are your goals? What are your time horizons? Right? What do you expect from market returns over a 5 year, 10 year period? Right? Some may say 7, 8%, and then you respond to them. What if the market's up 25%? Right? How are you going to feel? I think that somebody that has their emotions under control is going to say, I'll still take the 7, 8%. Others might say, I want the 25%. In that particular answer, you have some work to do with that investor, all right, to manage their expectations because it's not whether or not you're going to run into disappointing times. You absolutely will. It's just part of investing. But you need a long-term time horizon for and sticking with your plan um, uh, along the way. Obviously, your advisor in the most difficult times, or even in the best time, your advisor wants to be chatting with their investor to continue to manage their expectations.
And Joseph, you just mentioned the long-term time horizon, and Chris asked about FOMO. I mean, typically FOMO happens over these short-term time horizons. And short-term, if you're paying attention to every gyration in the market, that can be exhausting. Take this market with politics, with headlines, with whatever the case may be. That stuff can be exhausting for the average human being that's investing in the markets. And I think if you look at these things, and you have the benefit of hindsight when an event is happening in the market. If you fast forward a year or two or three, and you actually zoom out and look at, let's say, the chart of the S&P 500, many times these things are just blips on the radar, and you can't even see it when you zoom out and look at the long term. So I think that having a lack of concentration on the short term can be very, very beneficial to the typical investor.
Joseph and Ryan, excellent insights yet again. Thank you for your time.
You.
Thanks, Chris.